Continuing our discussion of Chapter 15, Auditor's Reports. We have described the unqualified audit report and its content. 5 circumstances, if material, require the auditor to modify the wording of the unqualified report, not the opinion itself, but the wording. Number 1, part of the audit is performed by another auditor. 2, there is substantial doubt about the entity's ability to continue as a going concern. 3, there is a material change in an accounting principle. We call that consistency exception. Number 4, a departure from GAAP is necessary to keep the financial statements from being misleading. And number 5, the auditor wishes to emphasize a matter about the financial statements. We'll discuss the 3 most common cases, the first 3, in the following slides. Let's briefly discuss the last 2 here. The departure from GAAP. Rule 203 of the AICPA Code of Conduct permits the auditor to issue an unqualified opinion when there has been a material departure from the accounting principles if the client can demonstrate and the auditor concurs that due to unusual circumstances, the financial statements would have been misleading had the accounting principles been followed. What constitutes unusual circumstances is a matter of professional judgment. In this situation, an explanatory paragraph is required before or after the opinion paragraph. The last one, the emphasis of a matter. The decision to emphasize a matter is also based on the auditor's judgment. Examples of matters that have been emphasized by audit firms include significant transactions with related entities, significant subsequent events such as a divestiture of a major segment of the business, and significant uncertainties. So let's talk about reports involving other auditors. About 50% of audits involve another auditor, either a network firm or an independent firm. Under the current rules, when other auditors are involved, the auditor must first decide if it is appropriate for him or her to serve as the principal auditor. In making this decision, the auditor considers the materiality and importance in qualitative terms of the portion he or she is auditing in relation to the total entity, and also his or her knowledge of the overall financial statements. Remember, the auditor has to express an opinion on the financial statements as a whole. Now, materiality we have discussed before. What is importance in qualitative terms? If the portion that the principal auditor is not auditing is part of the core business or an auxiliary business, that would indicate the importance. So the auditor must first decide if he or she is the principal auditor. Next, the auditor must decide whether to assume responsibility for other auditors' work. To assume responsibility, the auditor must be satisfied with the independence, professional reputation, and the work of the other auditor. In addition, the principal auditor must obtain and review and retain an engagement completion document consistent with AS3 from the other auditor. If the principal auditor decides to assume responsibility, the unqualified report is issued as if the principal auditor had done the entire work. No reference is made to the other auditor or his or her work. Otherwise, assuming that the principal auditor is satisfied with the independence and professional reputation of the other auditor, the responsibility is shared. The wording of the 3 paragraphs are modified to communicate the shared responsibility. We'll look at an example on the next slide. Before we do that, let's briefly discuss the amended PCAOB standard. The amended PCAOB standard requires that the auditor sufficiently participate in the audit to serve as lead auditor. The focus is on the risks addressed by the lead auditor, as opposed to the current standards, which focuses on importance of the parts and understanding the financial statements as a whole. So here is the example. The introductory paragraph identifies the parts, preferably by name, and their relative significance as a percentage of assets and/or revenues, the materiality concept. The other auditor need not be and usually is not identified. The scope paragraph also is going to change because now the opinion is based not only on what the principal auditor has done, but also on the report of the other auditors. The opinion paragraph is going to change also the wording. It is going to say, in our opinion, based on our audits and the report of other auditors, it goes on to say that the financial statements present fairly in all material respects, etc., etc. So you can see that the other auditor is not named in here, and the opinion paragraph signifies the shared responsibility. This is an area that is currently being debated by PCAOB because a lot of the auditors outside of the US, Canada don't adhere to the same level of professional skepticism and professionalism that we do. So the work that is done outside is normally not as good as the work that is done in North America. And so PCAOB has been after a lot of the accounting firms that have essentially outsourced part of the audit to other auditors and have not done a good job of looking at their work, investigating their reputation, and so on. Let's move now to the second circumstance, which requires the auditor to modify the wording of the unqualified audit opinion. Going concern reservation. If there is substantial doubt about the client's ability to remain a going concern, an explanatory paragraph is added at the end of the report, indicating that the auditor has substantial doubt about the entity's ability to continue as a going concern, and referring the users to the note in the financial statements explaining the problems and management's plans to overcome the problems. The other paragraphs are normally not changed. There is an exhibit in your textbook. I want you to go and look at it, Exhibit 15.4. There is also another exhibit which actually modifies the audit opinion. It disclaims an opinion under the condition of the substantial doubt about the client's ability to remain a going concern. That is not normal. So let's talk about the third circumstance that we wanted to talk about, lack of consistency. Consistency is affected by a change in an accounting principle, a change in the reporting entity, the entity we're reporting on has changed, and then material adjustments to prior financial statements. Change in the reporting entity requires a consistency exception unless the change results from a transaction or event. So a change in the reporting entity that results from a transaction or event such as the creation, cessation, or complete or partial purchase or disposition of a subsidiary or other business unit does not require recognition in the auditor's report. To identify consistency matters. The auditor should evaluate whether the comparability of financial statements between periods has been materially affected by the changes in accounting principles or by material adjustments to previously issued financial statements for the relevant period. Other changes, such as a change in an accounting estimate, unless the change is affected by a change in an accounting principle, that is, the change in estimate is inseparable from the effect of a related change in an accounting principle. Also, correction of a mathematical error and a change in classification also affect comparability. They do not, however, require a consistency modification. So the only things that require consistency modification are really the change in an accounting principle and material adjustments to prior period financial statements. The change in the reporting entity only if it does not result from a transaction or event. Now, when a lack of consistency exists, an explanatory paragraph is added at the end of the report identifying the nature of the change and referring the users to the notes in the financial statements. The other paragraphs are not changed. The amended standard has a somewhat different and longer list of circumstances that requires adding explanatory language to the unqualified auditor report. The main ones are listed here. Since we have already discussed these, I am going to just list them and let it be at that. Notice in here, though, that the emphasis of a matter has been moved out of the list, that it's a separate item. Not that it's important, but there is a distinction. The auditor does not have to emphasize a matter, whereas the auditor has to modify the language of the unqualified report for other circumstances listed here. So far we have only talked about unqualified audit opinion. Are there other types of opinion? We know unqualified opinion says the financial statements are fairly presented in all material respects in conformity with GAAP. Are there other types of opinion? The answer is yes. The auditor could qualify the opinion. Qualifying means excluding specific items from the auditor's opinion on the fairness of financial statements. We'll look at these in detail. There's also an adverse opinion. Adverse states that the financial statements do not present fairly in conformity with GAAP. And then we have a disclaimer of opinion. This is really not an opinion, it's a statement by the auditor that an opinion cannot be expressed. Clearly, the auditor's objective and the client's objective is to have an unqualified opinion on the client's financial statements, and the same with the internal control over financial reporting. The issuance of other than an unqualified opinion is unusual. The SEC, with limited exceptions, will not accept financial statements in which the opinion is modified because of a client-imposed scope limitation, inadequate disclosures, or violations of the accounting principles. To give an unqualified opinion, the audit must have been conducted according to the auditing standards, and the financial statements must be fairly presented according to an applicable financial reporting framework. So we know what the auditing standards are. We're not going to go there, but what do we mean by financial statements are presented fairly in conformity with the applicable reporting framework? I'm using the word GAAP in here again, although it is not the best term, it is short and sweet. This is not as simplistic as it sounds. The auditing standards specify the factors that the auditor considers in deciding whether the financial statements are presented in conformity with GAAP. Number one, the principles used are generally accepted. Generally accepted does not mean it is blessed by the SEC or the FASB. Remember the hierarchy of GAAP. That is what we are referring to. But more importantly, the principles have to be appropriate under the circumstances. That means the principles used should account for the substance of the transactions, considering changes in economic and other conditions. It is the quality, not acceptability of accounting principles that we are looking at. Number three, the financial statements must provide sufficient information understandable to an informed user. Number four, the information has to be classified and summarized in a reasonable manner. Professional judgment kicks in. And then the financial statements should not be materially misstated. Financial statement items are affected by the use of assumptions, approximations, and judgments. The auditor must be satisfied that the amounts presented are within an acceptable range of approximation. So these are the factors, again, that the auditor considers in making a decision as to whether the financial statements are presented fairly in conformity with GAAP. So we said we had other than an unqualified audit opinion. What are the circumstances that require the audit opinion to be modified? There are three. Again, if material is the key word. If it's not material, then it's okay. Three circumstances, if material, prevent the auditor from expressing an unqualified opinion. What are those? Number one is scope limitation. Scope limitation means the auditor has not been able to apply all the procedures that he or she deems necessary to obtain sufficient, appropriate evidential matter. Restrictions may be imposed by the client, such as client refusing to permit examination of minutes of the meetings of the board of directors, or client refusing to allow the auditor to inquire of the attorney, or refusing the auditor to confirm the receivables, deposits, and loan balances with the banks, etc. Restrictions may also be imposed by conditions, such as engagement occurs after the year end, or the records are inadequate. The second circumstance that requires a modification of the opinion, not the wording, is, although the wording will change as well, is the departure from the applicable financial reporting framework. These include use of inappropriate principles, improper application of principles, and inadequate disclosures. So let me give you an example of the first two. The last one is obvious. Use of inappropriate principle. For example, in contract accounting, the circumstances would tell us whether we should use the completed contract or percentage of completion method. If the client uses percentage completion, then the client should be using completed contract. That is using an inappropriate principle. Improper application. Going back to the same example, contract accounting, and giving you a case example, EC Ernst Electrical Contracting included materials en route to Saudi as part of cost incurred. So what? Remember the revenue recognition for contractors? We looked at the percentage of completion by dividing the cost incurred to the estimated total cost. So EC Ernst was pushing the materials en route as part of the cost incurred. In other words, jacking up the percentage of completion, recognizing more revenue than it should have. The SEC, of course, made them correct the reporting in that case. Lack of independence is the third circumstance. Now clearly, before we accept the client as audit firms, we're going to make sure we are independent, but one in a blue moon, maybe we find out later that we are not independent of the client. When other than an unqualified opinion is issued, the auditor briefly explains the circumstances in a separate paragraph before the opinion. Of course, the opinion also changes. So remember that the paragraphs come before the opinion. For the 5 circumstances that we discussed earlier that required the modification of the wordings, normally the paragraph shows up afterward, even though for emphasis of a matter and for the justified departure from GAAP, we said that the paragraph could be before or after. Just a quick note on the amended standard. Remember, under the amended standard, the first paragraph is actually the opinion. And so under the amended standard, the auditor needs to explain the circumstances in a separate paragraph after the opinion. So let's talk about the scope limitation. We said if material. Now, if materiality was difficult to interpret or to understand, we're going to make it a bit more difficult in here, because now we have to decide how material is this. Is it so material as to prevent the auditor from forming an opinion on the financial statements? Or can the auditor still form an opinion? If the effects are not so material as to prevent the auditor from forming an opinion on the financial statements, they're material but not so material, then we issue a qualified opinion. If the scope limitation actually prevents the auditor from forming an opinion on the financial statements, then the auditor disclaims the opinion. So let's look at the modification. Don't try to memorize this. Okay, for the 5 circumstances that we discussed before, generally speaking, the wording doesn't change much. There is a paragraph after, sometimes before. For the 3 circumstances that require other than an unqualified opinion, the opinion changes, and there is always an explanatory paragraph before the opinion paragraph. So think of what were in those paragraphs and see if these make sense. Remember, for instance, the introductory paragraph told us what statements were being audited, management's responsibility, and the auditor's responsibility. Have those changed when there is a scope limitation? The answer is generally not, and we disclaim we will change the introductory paragraph and we'll explain why. But generally, for qualified opinion, no. Did the scope paragraph, the nature of the audit change? The answer is yes, because the auditor was not able to apply one or more procedures that he or she deemed necessary under the circumstances. So you will see for the qualified opinion, the phrase, except as discussed in the following paragraph, at the beginning of the scope paragraph. We said we always have an explanatory paragraph. Clearly, the opinion paragraph is going to change to say, except for the effective scope limitation, financial statements present fairly, etc. There is an example in the textbook, Exhibit 15.8. Please make sure you read that. Now, what about the disclaimer of the opinion? Financial statements did not change. The auditor's and management's responsibility did not change. But if the auditor is disclaiming an opinion, it is better not to say that we have audited. It is better to say we were engaged to audit. And delete the last sentence. And it's better, in fact, to delete the scope paragraph altogether, because we don't want to confuse people as to what has been done, because we're disclaiming, we're not expressing an opinion. The explanatory paragraph is still added, and the opinion paragraph is going to say that the auditor cannot express an opinion. A disclaimer is normally issued if the client imposes the scope limitation. Again, under the amended statement, the separate paragraph comes after the opinion. Also, the amended standard requires relabeling the paragraph to disclaimer of opinion instead of opinion, and basis of disclaimer of opinion instead of basis of opinion. So the second circumstance, departure from the applicable financial reporting framework. Again, here we have to decide how material is material. Now we say, is it so material as to cause the financial statements to be misleading, or it's not causing the financial statements to be misleading, but still material? If the potential effects are not so material as to cause the financial statements to be misleading, then the auditor issues a qualified opinion. To issue a qualified opinion, the auditor is going to add a separate explanatory paragraph before the opinion paragraph to describe the reasons for the qualified opinion, the departures, and their effect. The opinion paragraph, of course, is going to change to say that except for inventory or except for omission of disclosure related to whatever, the financial statements present fairly. There is an example in the textbook, Exhibit 15.7. Please make sure you look at that as well. Now, why is it that I did not change the introductory or the scope paragraph? Because the responsibilities didn't change, the financial statements being audited didn't change, the nature of the audit did not change. The adverse opinion, if the effects of the departure are so material as to make the financial statements misleading, then an adverse opinion is appropriate. To issue an adverse opinion due to departure from GAAP, the unqualified report is modified in the same exact way, actually. A separate explanatory paragraph is added again to describe the reasons for the adverse opinion now, the departures and their effects, and then the opinion paragraph is going to change to say that because of the effects of the departure, the financial statements do not present fairly in conformity with GAAP. The third and the final circumstance, the lack of independence. When an auditor is not independent, then the auditor should issue a special disclaimer of opinion. Reasons for the lack of independence and any procedures performed should not be described. This slide summarizes the types of opinion issued in each of the three circumstances that we described. Make sure you understand that scope limitation means the auditor does not know. He or she lacks knowledge. Departure from the accounting principles means the auditor knows. And of course, lack of independence is obvious. So we have qualified, disclaimer, adverse, and a condition that gives rise to each of these. This is a good summary of what we have discussed. Now let's discuss our last learning objective, the auditor's report on comparative financial statements. When financial statements are presented on a comparative basis, now this is normal and mandated by the SEC. The fourth reporting standard requires the auditor to report on all periods presented. The discussion so far assumed four things. One, that the auditor is a continuing auditor. A continuing auditor is one that has audited the current year and the preceding year's financial statements. The second assumption, the opinion is the same for all periods presented. Last year it was unqualified, this year it is unqualified. Last year it was qualified for a scope limitation, this year it is qualified for the same reason. The third assumption, the opinion on prior periods is not revised. Why would the opinion for previous period be revised? Well, perhaps the scope limitation is removed, or in the case of departure from the accounting principle, that is corrected. And a fourth assumption is that prior year statements are audited. The audit report has to be modified when one or more of the above conditions do not hold. So let's talk about those situations. First, let's assume the auditor is a continuing auditor. A continuing auditor is responsible for updating the report on prior period financial statements presented. The updating is based on the information obtained in the audit of the current period financial statements. No additional or special procedures are applied. If the opinion expressed in the previous period is re-expressed, but it is of a different type, so no revision in the opinion, but they're of different type. Last year we had qualified for scope limitation. This year it's unqualified. The auditor has to combine the appropriate reports into a single report. Use your imagination to say last year was modified for scope limitation. This year it's unqualified. If the opinion on the previous period is revised, so the scope limitation has been removed and we can now issue an unqualified opinion for last year also, a separate paragraph is added before the opinion paragraph to disclose the date of the auditor's previous report, the type of opinion previously issued, in my example, qualified for scope limitation, circumstances that caused the previous opinion. Management refused to allow us to view the board of directors meetings, etc., that the opinion differs from the prior one. What if the auditor is not a continuing auditor? When the auditor is not a continuing auditor, one of two situations may exist. Either the auditor is succeeding another auditor, there is a change in the audit firm, or prior period financial statements were not audited. If the auditor is succeeding another auditor, either of two approaches may be taken. Number one, the current or successor auditor may refer to the predecessor auditor's report in the introductory paragraph and state that the prior period financial statements were audited by another auditor, the date of the predecessor auditor's report, and the type of opinion expressed by the predecessor, including reasons for any explanatory paragraphs which come for the situations we have discussed, for example, for scope limitation or departure from accounting principle, etc. Now, this is the most common approach. Another possibility, a second approach, may be for the predecessor auditor to update his or her report on prior period financial statements. In this case, of course, the predecessor must read the current period financial statements, compare prior year statements with the original, and obtain a representation letter from the successor that the current audit did not reveal any matters with material effect on prior period statements. The date of the reissued report should be the same as the date of the original report. What if prior period financial statements are not audited? Then the typical audit report for a public company is a report for the current year, followed by a paragraph simply stating that prior year financial statements were not audited. Happy learning.